All right, so let's peel back the layers of the market to really get at the code underneath it all. Turns out there are these fundamental principles that kind of govern how prices move, and, why making easy money is a whole lot harder than it looks. So here's what we're going to cover. We'll kick things off with a math problem that is super deceptive. Then we'll look at the tool the pros use to solve it. After that, we're going to zoom out and explore the really powerful theories that explain how the entire market operates. And finally, we'll tackle that million-dollar question. Can you actually beat the market? Okay, let's dive right in with a puzzle. Now, on the surface, this looks like super simple math, but it's a classic Wall Street brain teaser that trips up pretty much everyone, and it blows the lid off of a critical flaw in how we normally think about gains and losses. So, what does your gut tell you? You're probably thinking you're ahead, right? I mean, a 50% gain feels way, way bigger than a 33% loss. But this is exactly where the math gets tricky and leaves a trap that can fool even seasoned investors. And check this out. Your stock started at $100 and it ended right back at $100. So your net profit is zero. Zilch. And yet, if you just average the daily returns, the math says you made a positive 8.35%. So you've got this paper gain, but your bank account is telling you a completely different story. So how is that even possible? This isn't just some math quirk. It's a paradox that really exposes a massive flaw in how we track performance over time. That simple average return? Yeah, it's basically lying to you. Okay, so how do we fix this mess? Well, thankfully, financial professionals have a special tool just for this. It's a much more honest way to measure your performance, and it's called logarithmic returns. So, here's the absolute key. That 33.3% loss wasn't based on your original $100. No, it was calculated on the new, higher base of $150. Each return compounds on the last one, which is a multiplicative process. You can't just add them up and average them out. It just doesn't work that way. So log returns are kind of like this mathematical magic trick. They take those tricky, compounding, multiplicative changes, and they convert them into simple, additive numbers that you can actually just add up. And you don't need to be a math genius to get the benefit here. It makes tracking your true performance over time incredibly straightforward, and most importantly, accurate. And this right here really illustrates the core difference perfectly. Simple returns, they feel easy. They feel intuitive for just one day. But they get really deceptive when you start stringing them together. Log returns, on the other hand, are additive and honest. They give you the real picture of how you're actually doing over time. Okay, so let's run our little puzzle through this new system. Using log returns, that 50% gain, it translates to positive 0.405. And that 33% loss, well, that translates to negative 0.405. You add them together, and what do you get? A perfect zero. The math finally matches reality. You ended up exactly where you started with no profit. So now that we have an honest way to measure returns, we can start asking much bigger questions. If we can't trust simple averages, what can we trust about how the market behaves? And this brings us to one of the most powerful and honestly most debated ideas in all of finance, the efficient market hypothesis, or EMH for short. The main idea behind EMH is actually shockingly simple. The market is smart. It's so smart and so fast that by the time you hear a piece of news, a great earnings report, a cool new product, the price of that stock has already moved to reflect it. There are just no secrets hiding in plain sight. Now, this hypothesis comes in three flavors. The weak form says you can't get rich just by looking at old price charts. Then the semi-strong form, it goes a step further. It says even doing deep analysis on public reports won't give you an edge. And finally, the strong form, which is the most extreme, claims that even illegal insider information is already baked into the price. So what's the biggest takeaway from living in a supposedly efficient market? Well, it leads to one of the most foundational rules in all of finance. This brings us to a fundamental law of the market. There is no such thing as a free lunch. If a guaranteed risk-free money machine ever actually appeared, billions of dollars from traders all over the world would flood in to grab it, and in doing so, they would make that opportunity vanish almost instantly. Now, this kind of riskless profit machine, it actually has a name. It's called arbitrage. It is the holy grail for traders, making money with zero risk and zero of your own money invested. So let's walk through a classic example to see exactly how this would work. So just imagine this perfect setup. Some guru gives you a guaranteed tip. You can go borrow money at 5%, buy the stock, and then sell it for a guaranteed 10% profit. You use the bank's money, and after you pay them back their $105, you're left with $5 of pure risk-free profit. It is a perfect money machine. But, and this is a big but, here's why this just can't last in an efficient market. If this tip were real, everybody would rush to do the exact same trade, and all that massive buying pressure would instantly drive the stock's price up from $100, completely erasing that risk-free profit. The market and its efficiency is like a self-correcting machine that just slams these loopholes shut. So this all leads us to the ultimate question for any investor, right? If the market is so smart and so efficient at getting rid of these free lunches, can anyone at all, actually beat it consistently? Well, the weak form of EMH pours a whole bucket of cold water on one of the most popular trading strategies out there, technical analysis. You know, the idea that you can predict the future by finding patterns in old price charts. According to the theory, it's a total fool's errand. And as you're about to see, some of the world's greatest investors couldn't agree more. Warren Buffett had this great line. He said he knew technical analysis didn't work when he turned a chart upside down and basically got the same answer. His point is that the patterns people think they see are often just random noise. I mean, if the pattern works both ways, it's not really a pattern at all, is it? The legendary fund manager Peter Lynch put it even more bluntly. He just said, charts are great for predicting the past. They're perfect at telling you what already happened, but they offer almost no real insight into what's going to happen next. And maybe the most savage critique of all comes from the economist Burton Malkiel. He wrote that financial forecasting is a science that makes astrology look respectable. Ouch. He's essentially arguing that trying to predict short-term market moves is nothing more than pure guesswork. And all of this leads us to this really fascinating paradox, right? The market is only efficient because millions of smart, ambitious people believe it's not efficient, and they spend every single day hunting for an edge. It's their constant competition that closes all the loopholes and makes the market so tough to beat. Which leaves me with one final question for you. What do you think would happen to the market if everyone just gave up? If they all finally believed the theory was true and simply stopped trying to beat it?